Okay. How individuals, businesses respond to government's policy. Okay, those are the things we would like to be exploring in most of the time we'll be spending here. Okay, so we hear things like inflation. Inflation is simply a macroeconomic concept. Okay, because we are looking at the prices of goods and services for the entire economy. Okay, so the data you see here is inflation rate for August. Okay. Okay, so the data you see here is inflation rates between 2011 and say 2018. So every specific year has, in fact, it is calculated on a monthly basis. Okay, it's calculated on a monthly basis. So for every month, we have the inflation rate associated with that particular month. And this inflation applies to the entire country. So they say inflation rate for August 2029 is 2021, August 2021 is 9.7. It's not in the data here, but just to show you that, I mean, there could be, for every month you can have a certain inflation value. Okay, all right. So there's no data for 2021. No, this is 2016, 2018. So there could be 2020 somewhere here. Okay, all right. So what we are interested in here is, can we try and explain what has caused? So you can see that between 2010 to 2014, inflation has been following some form of a downward trend. Between 2014 or before 2014, slightly before 2014, sometime after 2016, inflation has been increasing. And then slightly after 2016, all the way to say inflation has been dropping. The question is, from a macroeconomic perspective, what has been causing general prices to be increasing? If we understand what has been causing it, then what are the implications of an increase in general prices on businesses and what on individuals? Again, we'll ask ourselves, what has been causing the inflation rate to do what? To decline. What has been causing the inflation rate to do what? To decline. What is the implication of this declining inflation rate on businesses? What is the implication for individuals? So those are the type of questions that we will be answering for most part of the lectures that we'll be doing this semester. Okay. All right. Now let's move on. So those are some of the things we'll be doing, okay? We'll be doing a lot of these things. And I'm very sure you are pretty familiar with this particular word, GDP, okay? Gross domestic product. Oh, my voice is low. Okay, so let me see if I can project a little bit for you to hear. Can you hear me now? Can you confirm if you can hear me? Is it better now? Okay, all right, okay. So I'm saying that I'm pretty sure you're familiar with this particular term, GDP, okay? Gross domestic product. It's a macroeconomic concept simply because it is looking at the entire economy. So there is a value for GDP for Ghana. You will get a value for GDP for the US, for the UK, okay? Because it's looking at the aggregates, okay? That's why it's a macroeconomic concept. So the whole thing is, how is this particular GDP measured? It's something that throughout the semester, we will be taking you through it. You need to know how it is measured. What is even economic growth? So economic growth is just the growth rate of GDP. What is it? Why does it matter? How is it measured? Those are the kind of things that we'll be taking you through. Why does the economy grow fast sometimes and sometimes does not grow fast? Okay, so here we have a trend of GDP data, I think from 2010 to 2020. Okay, you see the cyclical nature. It increases in some, well, now we even have quarterly GDP. So we have it quarterly. So for some quarters, it's increasing. For some quarters, it's decreasing. What is accounting for this? Is the increase or decrease in GDP good news or bad news to the economy? Okay, is it good news or bad news to businesses? Is it good news or bad news to individuals? Those are the type of questions that we'll attempt to answer. Okay, and I mean, as I said earlier on, they are all macroeconomic concepts that you are supposed to be familiar with. Again, the key word here is we are not looking at individuals or businesses, but we are looking at their behavior in aggregates. Okay, so that's what makes micro, MI micro different from MA macro. All right. Okay. So some other things we'll be looking at is exchange rate. Exchange rate, the price of what of the price of money. Let me say. So, for instance, there is an exchange rate that exists between the Ghana cedi and then what the exchange the US dollar. Okay, there's a particular rate by which you can more or less change your currency from the US dollar to what the US dollar to the Ghana cedis. Okay, so there are some concepts we will introduce you to. Some of them are depreciation, some of them are what appreciation. Okay, why is the Ghana cedi always depreciating? All right, we'll take you through it. You tend to understand why it is always depreciating. What that basically means is that you need more units of the Ghana cedis to get the same dollar. Why is that happening? Okay, what is the implication of this for other economic variables? Okay, other economic fundamentals. Okay, or what even determines this particular exchange rate? These are things that, for most part of the semester, we'll be taking you through. Okay, for most parts of the lecture, we'll be taking you through. Okay, so I'm trying to keep the house in order. Let me see if I can. Okay, so I'm just trying to save bandwidth so that those who are trying to share video will not be able to do that anymore. All right, now let's move on. There is this information about labor force reports. Okay, so you see in those reports, they say that 9.1% of the labor force was unemployed. Of the total labor force in the country is unemployed. Is it good news? Is it too low? How do we come about these numbers? And what does the number even mean? Okay, those are some of the things we'll be taking you through for most part of the semester. Okay, all right. Now let's move on. You hear things like Monetary Policy Committee of the Bank of Ghana has maintained the policy rate at 13.5% in the last meeting. Okay, so there's something called monetary policy, and monetary policy, in very crude or basic form, is more or less to control the financial sector. How much money is in the system? How much more do we need? How much less do we need? Currently, we are doing something called inflation targeting, where a monetary policy committee meets to what they use to more or less undertake monetary policy now is what they call the policy rate or the prime rate. So periodically, they do meet to either increase the prime rate or decrease it. The intention is either to boost economic activities or reduce it. So for our purposes, we want to understand what does this mean in terms of cost of borrowing for small businesses. Okay, so those are the type of things that I mean we'll be looking at. We'll be looking at throughout. Okay, so in March 2018, the BOG introduced a new method for setting interest rate called the Ghana reference rate. What was the rationale? What does it? Why does it matter? These are questions we'll be asking ourselves and trying to do what? Provide answers. And you realize that it runs through most of the questions that are being asked are things that will affect the behavior of individuals or the behavior of what? Of businesses, not a particular single individual. The emphasis is not much on a particular single individual like we do when we are studying MI, microeconomics. Okay, so macroeconomics studies the economy as an aggregate unit. It is not like micro, which focuses on what? An individual market, no. Or an individual person, no. We are looking at what? Aggregates. Okay, so macro focuses on all markets that are aggregated into what? Into one. Or all individuals that are aggregated into what? Into one. Okay, so that's the basic distinction between MI micro and then MA macro. All right, so I can see some people are trying to get me to scream. I hope you can hear me. Is it better now? Let me know if it's better. Okay. I assume it's better because there's no response yet. All right. Okay. So basically, that's the distinction between MA macro and MI microeconomics. Okay. All right. So the typical issues that we'll be studying in macroeconomics is the concepts of GDP, gross domestic product, employment, unemployment, inflation, interest rates, fiscal and monetary policy, economic growth, business cycles. Okay, so those of you that can't hear me, I have a feeling it's got to do with your connections. All right. But I'll try and see if I can keep my voice loud a little bit for you to hear. Okay. All right. Okay. So these are the things that we'll be studying in macroeconomics. Okay. GDP, employment, unemployment, inflation, interest rates, fiscal monetary policy, economic growth, business cycles. Those are the type of things. Okay, those are the type of things that we will be studying. Okay, those are the type of things we will be studying. Okay. All right. So there are two main issues in macroeconomics that we cannot run away from. The first one is long-run economic growth. The whole idea is what determines this particular long-run economic growth. Later on, when we go through the growth theory, you see one way of measuring growth is through the GDP or GDP per capita. So the question is, what determines this long-term per capita income? Why is it that some countries are rich, others are poor? Okay, so in the long-run economic growth, those are the issues that we'll be interested in. Okay, then we have the second thing that's got to do with what? Business cycles. When I showed you the graph for GDP, you saw how it was at some point increasing, some point decreasing. The issue is these are the short-term fluctuations in output. So the whole idea is what causes recession? Recession is more or less a situation where the GDP trend is following a downward trend. Okay, so what is causing this particular recession? Are they all alike? Can they be avoided? How can we use monetary and fiscal policy to minimize these economic fluctuations? Okay, all right. So this is what I was. Let me try and go back. Oh, then. Okay, so I'm not able to. I wanted to just go back and then go and show you those fluctuations. Okay, but these are things we'll go through. Okay, we'll go through when we more or less. These are things we'll go through when we pick on the topics one after the other. So don't worry so much about that. Okay. So these are the big themes that when you say you have read macroeconomics, should have gone through it, should be familiar with it. Growth, what determines long-term growth? Why are some countries rich? Why are some poor? Business cycles, what causes recessions? Are they all alike? Can they be avoided? Is there an economist speed limit? Okay. Inflation, what causes inflation? Why should we care about inflation? How can we control inflation? These are things by the end of this particular course, you should be able to provide some form of answers to. Okay, monetary and fiscal policy. What is monetary policy and what is fiscal policy? Can monetary and fiscal policy stabilize the economy? How? Why does the BOG target inflation? And why is it that even it is the BOG that should be interested in how to do more or less manage inflation? What is the main objective of the BOG? BOG is Bank of Ghana. Okay, so these are things we'll try. When do budget deficits become a concern? All right, these are even what is budget deficit. But before we end this semester, you should be able to understand what budget deficit is. Okay, why should we be concerned about? I'm sure you've been hearing it on the radio that Ghana's budget deficit is going high, and people are saying, well, it's a cause to be concerned. You have to be worried about it. And you by the end of this semester, you should be able to understand and explain why it is a concern. Okay, why do financial markets respond to macroeconomic news? Okay, why is it that when there is a shock, when I don't know if you've been following the stock markets, immediately there was news about the coup in Guinea. You heard what happened to the price of, I think, is it aluminium or something, or even in U.S. elections. You see the effect it has on what the stock markets. Okay, those are some of the. Okay, so those are some of the things. We'll be taking you through for you to understand why financial sector must respond to any macroeconomic news. Okay, why is it that when there's a big announcement by President Biden, then all of a sudden the U.S. stock markets are all shaking? These are things we'll try and take you through for you to have a fair understanding of. Okay, all right. I know it's a pretty large class, but when you have a question, you can either type it for me to try and provide a response, or you just raise your hand and periodically I'll allow you to ask questions. Okay, all right. Okay. So why do we study macroeconomics? It's simply because we want to understand issues from an aggregate perspective. But the issue is no single person can control these aggregate issues. The most important person that can control that is the government. So the reason why you are studying macroeconomics to understand the impact of government policy. Okay, they are in charge, so they can come up with actions that can affect the aggregates of, when I say the aggregate, in terms of the behavior of businesses and the behavior of and the behavior of firms. All right, behavior of businesses and the behavior of firms. Okay, all right. So we want to study macroeconomics so that we can understand exchange rate movement and the impact it has on other economic variables. Okay, you hear on the radio, most people are worried when the Ghana cedi keeps depreciating. We are worried because of the impact it will have on the price of goods and services. We are worried the impact it will have. The effects can spiral over various economic variables, even on interest rates. We are worried. So we study economics because we want to understand the impact of exchange rate movements on other impact of exchange rate movements on other economic variables. We want to study macroeconomics because we want to know interest rate fluctuations and the effects it has on the cost of borrowing. Okay, we want to study macroeconomics because of financial markets, and because financial markets and investors respond to macroeconomic news. Okay, I was earlier on telling you about the example of what happens when President Biden makes a huge statement. Okay, in our part of the world, we don't see the effects too much of an announcement from, say, the president of Ghana on the stock activity. We don't see too much of that, but in the advanced world, a single announcement. And in fact, let me give you an example of what happened when there was a coup in Guinea just a week or two ago. Prices of aluminium started rising. Okay, people were worried, they were concerned because Guinea is one of the, I'm not sure if it's aluminium or I've forgotten the exact mineral, but it's one of the countries that produces almost a lot. I don't know the percentage too, but they are one of the most important producers of that particular resource in the world. Okay, and this resource is used a lot by other countries like China, the UK, and that kind of thing. All right. So those are the reasons why we study macroeconomics, so that we can do sales forecasts and that kind of thing. Okay. All right. So let me pause here for a second and allow one or two people to ask a question. And please feel free. This is a very large class, so it will be difficult to allow a lot of people to ask questions, but feel free to type the questions Any question you have, just feel free and type it in the chat box. Periodically, I'll go down there to check what is going on there and try and provide some responses. Okay, all right. So let's move on. Let's start by looking at some of the basic concepts that we'll be using throughout. Okay, some of the basic concepts that we'll be using throughout the class. The first one we'll be looking at is GDP. I already gave you an idea of what GDP is. I mean, we are looking at the market value of final goods and services newly produced within a fixed period of time and within the geographical boundaries of a country. All right. So the keywords are those in. Okay, so Rhoda, I've seen your question. This is a question that we'll come to later on. All right. Does GDP of a country have any connection to do with the exchange? Please, when the inflation rate is declining, is this still inflation? So these are things okay, so somebody was telling me it's bauxite. I've forgotten exactly the resource, but it's one of them. Okay, all right. So let's come back to our GDP. So GDP, we are interested in what? The market value of goods, of final goods and services. The reason being that the only way you can put together goods and services is when you provide a market value for it. Okay, that's the only way you can put together goods and services. There should be a market. So if I go to a hotel and I stay in a hotel, the value that I pay is probably how much I paid to stay in the hotel. If I want to add that to, say, a good I buy, the best way is to look at the value of the good so that I can add the value of the good to the value of the hotel and more or less aggregate it. All right. So that's why the emphasis is on what? Market value of final goods and services. And you get to understand it and why we are saying final. Okay, you get to understand why we are saying final. Simply because in the production of some goods, there's something called an intermediate input. So you will come there when we distinguish between the two approaches. Either you use the intermediate approach, value-added approach, or you use the final. But by definition, what we are interested in is what? Final. Okay, final use. Okay, final use. Okay, so we are looking at the market value of final goods and services newly produced. We are not interested in inventories that have been produced some years ago and stored somewhere. All we are interested in is what? Newly produced goods. And we are looking at the time period. It should be within a fixed period of time and within a specific geographical boundary. So look at the keywords quite closely. Okay, market value of final goods and services newly produced within a fixed period of time and within the geographical boundaries of what? Of a country. Okay, so that's the definition of what? Of GDP. Okay, so that's one of the basic concepts that we'll be using throughout the lecture. Okay, then another one that you should be familiar with is what is unemployment. Okay, and there's a standard definition for unemployment. Again, the keywords. So if you are asked to provide these definitions in, okay, so Vanessa, let me see how easy it will be for me to allow you. Okay, so Vanessa, you can unmute and ask your question.
Sir, please, it's actually a suggestion.
Okay.
Sir, please, I was wondering if you could record the class section so we can use it for reference or revision at any time.
Yes, I'm saying earlier on I explained that I'm not using my account, so I don't know if the owner has storage space. I don't know.
Okay.
Yeah. So in subsequent classes, when I get my own Zoom account that I can control, I'll make sure it is recorded. Okay. All right. And then there's something in the chat. Let me see. Okay. All right. So I think it's just a response to what I have just said. All right. So GDP is a concept. And as I said, make sure the keywords are those in bold. And definitely when you are asked to provide some of these definitions in exams, these are the keywords we expect to do what? To see. Okay. These are the keywords that we expect to see. Okay. Is it Vanessa again? Yes, Vanessa. Okay. All right. Okay, so the next keyword we'll be talking about is what is unemployment. Again, I'm saying that the keywords are those in bold. When you provide your definition and these keywords are not there, then there is a challenge. Okay, so unemployment, we are looking at the number of people who are one, available to work and actively looking for work but cannot find. So you should be available for work and actively looking for work. Those are the two keywords. You should be what? Available to work, and you should be actively looking for work, but cannot find the job. Okay, so that becomes an unemployment. So unemployment rate is simply the fraction of the labor force. So the labor force contains both those that are employed and those that are what? Unemployed. And then there's a third thing. There are a few people who are out of the labor force. Those are things we'll come to later on. Okay, they are entirely out of the labor force. Okay, so unemployment rate is just the fraction of the labor force that is unemployed. Okay, so the fraction of the labor force that is unemployed. So the unemployed, we are defining the unemployed as those who are available to work, actively looking for the work, but cannot find the work. Okay, he should be available to work, actively looking for the work, but cannot find the work. He's unemployed. So that particular unemployed divided by the labor force should give you what? The unemployment rate. Okay, it should give you the unemployment rate. All right, so we'll come there. I was just trying to go into the chat box to click on a few questions. Salom, I've seen your question. Don't worry, these are things we'll discuss later on. So don't worry about it at all. Okay. All right. So please, earlier on, especially for those of you joining now, I was saying that try and add your index numbers so that we can use that to track class participation and then more or less be able to take care of the class assessment. There's a 10% component of the total assessment that we will dedicate to class participation. All right. So please add your index numbers so that we can use that to track. All right. Now, another key concept that you should know about, and which we'll be using throughout, is inflation. Okay. Here too, there's a keyword and it is in bold. So inflation is nothing but the rate at which general average level of prices in an economy is what is increasing. Okay. It is the rate at which the general or average level of prices in an economy, okay, is increasing. That is inflation. It is the rate at which the general level of prices in an economy is increasing. Okay, general level of prices. So the opposite of inflation is what? Is deflation. Okay, refers to the decrease in the general level of prices in what? In an economy. The decrease in the general level of prices in an economy. Yeah. Okay. All right. So these are some keywords that you should be familiar with. In fact, for most of these keywords, we'll pick them one after the other and then try and go. And then we'll try and go through it. I mean, we'll take them one after the other and then try and understand it much more. Okay. Then there's this thing too called business cycles, which refers to the short run contractions and expansions in an economic activity in an economy. So we are looking at the cycles of recessions and recoveries that characterizes economies in the short run. Okay, so these are concepts that you should try and be familiar with. You should try as much as possible and be familiar with the Enoch. I'm not saying you should send me your name and your index number. Your name that is showing in participants, I just want you to rename yourself and add your index number so that I can use that to track class participation. All right? Okay. So let's move on. Let's see what is next here. Okay, so one of the things you should also be familiar with is what is macroeconomic policies. There are two main sets of policies or tools available to the government for making short-term economic decisions. All right. So, for instance, I don't want to jump the gun, but if there is too much money in the system and it is causing inflation, there's an institution called the central bank, and it is its role to make sure they tame inflation. Okay, so there's something called monetary policy, and it refers to changes in money supply that are used to affect the level of economic activities or control the rate of inflation. And the reason why the focus of monetary policy is a role for the Bank of Ghana is simply because that's one of their main objectives. Okay, all right. One of their main objectives is more or less to be able to use the tools at their disposal to be able to do what? To control inflation. All right. They have a policy of ensuring that prices are stable, relatively stable. Okay. So Ghana has its own objective to keep inflation between plus and minus, I think 6% or something. Yeah. No, it's between 6. So it's plus or minus 8. So between 6 and 10. That's the target of the Bank of Ghana to be able to keep our inflation rates. All right. So any policy by the central bank or the Bank of Ghana to tame money supply is referred to as monetary policy. Then we have the alternative, which is fiscal policy, which is it refers to the use of government spending and taxes to affect the economy. All right. So that one is done by the government. They can either increase their expenditure or generate a lot of revenues through taxes. And these two things that they can do, they can use it to again affect what? The economy. Okay, so these are things. I'm trying to go back into the chat box. Okay, so don't worry so much. We are just going through concepts. I can see some people are asking for me giving an example of a recession. Don't worry, these are things we'll pick one after the other. For now, what we are doing is just to take you through some of the basic concepts. If you understand these concepts, the moment you try to explain them in greater details, it shouldn't be difficult. It shouldn't be difficult for you to follow. Okay. So there's fiscal policy, which refers to the use of government spending and taxes to affect. Okay, let me see if I can allow Akosia. Oh no, I can't see her again. She raised her hand briefly. I can't see the hand anymore. All right. Okay. So that's basically it. Okay. Let me see. Okay, and then, okay, let me see if I can allow Akosia to ask her question. Yes, Akosia, you can unmute and ask your question. You can unmute and ask your question. Okay.
Sir. Hello. Sir.
Yes, I can hear you. Go ahead.
Sir, please, I didn't understand. Okay, please, I didn't understand the monetary policy. I wanted you to go over again for me.
Okay, all right. Okay. All right. So monetary policy, all it's referring to is okay, let me put it in a very simple way. The main agent or institution that is supposed to conduct monetary policy is the central bank of a particular country. And you know, the central bank is the one in charge of controlling the amount of money in the system. All right. Sometimes when there is too much money in the system, okay, it can cause inflation, can cause other sort of things. So monetary policy is all about changing the supply of money in the economy to be able to. So, for instance, if there's too much money in the system, the only thing the central bank does is to try and take away some of this money from the system so that it will tame inflation. All right. So, Asantua, was she the one? Yeah. So it's all about the central bank trying to control the supply of money in the economy to be able to affect some economic activities, all right, or affect some economic variables that are of interest. And the key economic variable that is of interest to the central bank is the inflation rate. Okay, is the inflation rate. So monetary policy is conducted by the Bank of Ghana, and then fiscal policy is conducted by what? The government through its spending or what? Through its spending and through its taxation. Okay. All right. So for now, don't worry too much. We'll pick them. In fact, when we start dealing with this ISLM thing, you understand much more what I'm trying to refer to. Okay, because we'll have diagrams that will explain clearly to you what is happening. Okay. All right. Okay. Now, in macroeconomics, there are some two. It's called approach here, but I would prefer to call it school of thought, okay, or disciplines that more or less they've consistently made predictions about how the economy, the macroeconomic outlook. Okay, so there are two approaches. We have the classical approach and then the Keynesian approach. Okay, the classical approach and then the Keynesian approach. More in summary, most of the agreements that people have in positive macroeconomics, they have their roots in disagreement between these classical economists and then the Keynesian economists. So classical economics will tell you, let the economy be on its own. It is self-equilibrating. There is some invisible hand that will make sure that demand and supply will meet and prices will be determined. Then there is this Keynesian group who say, no, the economy cannot be left on its own. There should be some deliberate action to ensure that economic agents act well. Okay, so you see, one school is saying, just leave the economy alone to correct on its own. Another one says there must be some form of intervention. Okay, so most of the debates will be going through, or most of, let me put it this way, most of the disagreements that you'll be seeing when we go along has to follow the line. More explicitly, it follows the lines of disagreements between this classical and then this Keynesian school of thought. Okay, well, these are things we will take you through one after the other. All right, we'll take you one. Some of them you'll see very stark contradictions. That somebody says, I don't have a very good example of head that will make it easy for you to understand now. But as we go on, I'm very sure I'll get some examples that will help you. Okay. Yeah, I can see some people are ahead of us trying to tell us that one of the ways the central bank conducts its monetary policy is through treasury bills. Yes, I can see that. That's very good of you, Sechi Betty. If it were to be a face-to-face class by now, I would have recorded some 2 marks for you for trying to go ahead of the class, which is very good. Okay, so I think you are responding to the question by Adelaide. All right, okay. And Teresa. Okay, all right, okay. So don't worry so much. For now, I'm just taking you through or introducing you to the concepts. I mean, these are things we'll discuss. We'll deliberately discuss them each. We will discuss them one after the other, and then you have all the opportunity to ask all your questions. Don't forget, today is just an introductory class, and I'm just trying to introduce you to some of the concepts. So don't worry so much. We'll pick them one after the other, and then you'll get to understand it. Okay. All right. So at the heart of this disagreement is the speed of adjustments of prices in various markets. Classicals following Adams, I think I've mentioned this already, invisible, and they believe that markets adjust almost instantly. So all markets are always in equilibrium. This gives no room for fiscal policy or monetary policy. Nobody should, as I said earlier on, that's what the classical economists believe. Leave the economy alone. Nobody should conduct any sale and purchase of treasury bills to influence money supply. No, nobody should increase government spending or generate more revenue. No, nothing of that sort should happen. I mean, that's what the classical people believe in. And then the Keynesians say that adjustments are important. So the Keynesians believe that adjustment can take a long time. The economy can be in a disequilibrium for a while. In the long run, we are all what? We are all dead. Okay. So they are the action, the interventionist. That's the word that is more popularly used for them. Okay. There could be you can't let the economy be on its own. Sometimes adjustment can take a long time. So there's the need for you to do what? To act, to conduct some form of monetary policy, to conduct some form of fiscal policy in order to attain certain economic objectives. Okay? In order to attain certain economic objectives. So I mean, these are the two approaches that you'll be seeing as we go through. We go through all the courses. And then one thing too you should know about is this thing called the circular flow model. Okay, it's a very simple. So the circular flow model is a simple way to visually show economic transactions that occur between households and firms in an economy. Okay, so let me just quickly go to the diagram. And okay, so the long and short of it is that the households, so this is the diagram actually. So households own the factors of production: land, labor, land, and capital. And it is firms. The firms need these factors of production as inputs to be able to produce something. So we have households who own the factors of resources. We have firms who don't own these factors of production. They have to rely on the households. Okay, so they use more or less the factors of production from the household. They use that as what? As inputs to produce what? Goods and services. And who buys the goods and services? It's the households who buy the goods and services. So that completes the red line. Okay, it completes the inner transaction that occurs between. So the inner, I'm just referring to the red line, okay? So the transaction that occurs between the firms and the households. So let me just go over again. Households own the factors of production. Okay, let me try and get some. Okay, all right. All right, so I was trying to look at the chat box to see the type of messages there and try and see, but I can see some of your colleagues have responded to you. All right, so I'm saying that the households own factors of production, which is land, labor, and capital. But these factors of production are inputs required by firms to produce what? Goods and services. And then who buys the goods and services? It is the same households. But look at something. When households provide the factors of production to the firms, they pay them something. Okay? They pay them something. All right? So when the households provide the inputs to firms, the price of labor is wage, the price of land is rent, and capital gets a profit. And this comes in the form of income to households. Now, the goods that the firms produce, the incomes that the households get from the firms, that is what they use. That is what they spend on. They spend that income in buying the goods and services that is produced by the households. But when they buy these goods and services, it's in the form of what? A revenue to the firm, okay? Right, so let's just backtrack a little bit. Anyway, okay. So the circular flow model is a simple way to visualize how economic transactions occur between households and firms. So firms hire and use the factors of production from households for use in their production process. And then the firms then produce and sell the goods and services to what? To the household. So this is a very simple way of how economic transactions occur between households and what? And firms. Okay. And I hope you understand this diagram. It's not very difficult, very difficult to understand. So once again, households provide inputs to firms. Firms use the inputs to produce goods and services and sell it to the households. When households provide these inputs, the firms pay back in the form of rent, wages, and profits, which is incomes that goes to who? The households. The households use this income, they spend this income on the goods and services and goes back to firms in the form of what? In the form of revenue. This is not very difficult to understand. Okay, it's not very, very difficult to understand. So households are the owners of the factors of production. They sell these factors of production to firms in return for wages and rent. With these incomes, they buy and consume goods and services produced by firms. Okay, they buy goods and services produced by firms. Okay. All right, so market for, okay, all right. So that completes the cycle. And then let's see what is here. Okay, so the market for factors of production. Households supply factors of production. Firms buy the factors of production. And the factors of production, I've already shown that to you, land, labor, and capital. Then there's a certain market. Okay, so here what it is referring to is just distinguishing between the market for factors of production and then the market for goods and services. So in the market for factors of production, it is the households that own the factors of production. Okay, they own the factors of production, and it is the firms that demand the use of these factors of production. And the factors of production you are referring to are land, labor, and capital. Then when you come to the market for goods and services, it is the firms that sell the supply side. They sell the goods and services. So for the factor market, the supply side is the household who sell their factors of production. When you come to the goods side, it is the firms that are the supply side. They sell their goods and services. Okay, so this distinction is very important for you. In the factor market, the supply side is the households. In the goods market, in the goods and services market, the supply side is what? Is the firms. In the market for factors of production, the demand side is what? Is the firms. But in the markets for goods and services, the demand side is what? Is the households. These are things you should be familiar with in your IA that we will be writing. Definitely, some of these things will come up. Don't get confused. All right. Always know what the supply side is and the demand side is for each of the markets. Okay. Let me take some 1 or 2 questions. So if you have any question, just raise your hand, and then is there any question? Any question? Anyway, all the same, along the line, if you have a question, just raise your hand. I'll allow you to unmute, and then you ask your question. All right. Okay, so let's move on to national income accounting. Okay, there's one message here. Yeah. So those of you sending, I mean, I don't know exactly what is happening to these group things, but I completely understand you that last semester, I think there were 7 or 8 groups. Now you're having 4 groups. So that overlap will be there. I don't know exactly the communication about how this grouping is done, but don't worry. I mean, I'm fine. I'm fine with you joining the group for now. I'll try and find out from the coordinator exactly what is happening so that I'll know exactly how to provide. I'm very interested in class attendance. So I would like to award the 10 marks to all those who come for all the 12 lectures. Okay, and I will if you come 6 times, I'll give you have 5 out of 10, that kind of thing. All right. So I again will indicate that if you are here, irrespective of which group you belong to, so far as you are here, please rename yourself and add your index number so that I can use that to do what? To track class attendance. Okay, I can use that to track class attendance. So let's move on to national income. I think this is where we will spend a lot of the time. Okay, Lowell Achampon, you can unmute and ask your question. Or you don't.
Hello, sir.
Yeah.
Yes, sir. So please, if I'm to understand you well, it means when it comes to the market for production, the household is the one who supplies and the firms demand.
Exactly.
And when it gets to the market for goods and services, firms supply.
Exactly.
Whilst households demand.
Exactly.
Okay, thank you.
All right. Okay. All right. So let's move on to national income accounting. This is not very difficult. Okay. We want to. So the whole idea of national income accounting is to try and come up with a value that will measure the GDP of a particular country. So national income accounting refers to the framework for measuring the current level of economic activity. That is all national income accounting is about. Don't forget from the beginning, what I told you was that we'll try and understand what GDP is. By definition, you already know what GDP is, but how do we measure the GDP? Okay, that is what we are trying to do now, national income accounting. Okay, all right. So by current level of economic activity, we mean GDP. So in Ghana, the calculation of GDP is done by the Ghana Statistical Service. And there are three main approaches to the calculation of GDP. If you followed the earlier arguments, I was telling you that you could use, okay, so let me just go through the three stages. All right, so there is the amount of output produced, excluding output used in intermediate stages. I spoke about this earlier on. Okay, so for those of you that have read economics before, this is what the output or product approach for calculating the GDP. Okay, the product approach or output approach to calculating the GDP. What we are interested in is the final units, the market value of all output that are produced. Outputs produced at the intermediate stages are taken out simply because of the problem of us double counting. I'm not so sure if I haven't looked at the other slides to be sure, but we'll take them one after the other, and then we'll explain it to you what that intermediate thing really mean. So there is the output or product approach, where all we are interested in is the amount of output produced, or output produced at the intermediate stages. So, okay, now let me try and give you an idea of what. Okay, there's this example I often use. I've forgotten. Don't worry. I'll try and look for that example and then maybe share it with you. Okay. All right. So there's apart from the output and the product approach, there's also the income approach. Here we are looking at the incomes received by the producers of outputs. The incomes received by the producers of output. So there's the first one, output or product approach. There's the second one, which is the income approach. And then there's the last one, which is the expenditure approach, which is the amount of spending by the ultimate purchasers of outputs. The amount of spending by the ultimate purchasers of outputs. Okay, so three approach for national income accounting: the output or product approach, the income approach, and then there is the expenditure approach. All right. Okay. Let's move on. So we defined GDP earlier on. We defined GDP as the market value Isabella, I don't quite understand your question. All right. I think you are referring to this slide. So I still think, so there's the output or product approach, there's the income approach, and then there's the expenditure approach. Okay, I don't quite understand your question, Isabella. If you can retype the question. All right. So as I said earlier on, GDP, we are looking at the market value of final goods and services newly produced within a fixed period of time and within the geographical boundaries of a country. okay, newly produced within a fixed period of time and within geographical boundaries of a country. All right. Now, we are interested in what? Market value. So we value each good at the prices at which they are sold. So we cannot add oranges to taxi services. I was talking about this earlier on. We convert their physical quantities into what? CD value. Okay. You cannot add oranges, physical quantities, to a service like taxi service. What you have to do is to convert it into what? Monetary terms, the CD value. So the CD value of all oranges, the CD value of all taxi services, put all together, then you can get your market value. Okay, you can get your market value. Again, we are also interested in only final goods. We exclude intermediate goods to avoid the problem of what? Of double counting. Okay, we exclude intermediate goods to avoid the problem of what? Of double counting. And finally, we are interested in only newly produced goods and services in that period. Purchases of goods and services produced in the previous period, they are excluded. The reason why they are excluded is that in that past period, so for instance, if we have 2020 and 2019, you cannot bring a good that was produced in 2019 into 2020, simply because it was accounted for already in 2019. So when you get to 2020, what we want is what? New goods. Okay, so that's those. So the key words, the words in bold. Okay, so intermediates, Kamam. So intermediate goods are goods that you need to be able to produce a final good. So more or less, let me give. So assuming I want to do bread. All right. Okay, Isabella, I'll respond to your question pretty soon. All right, so let me try and explain the question that was asked by Kamam. So intermediate goods. So the goods, if I want to do bread, the type of things I need to be able to bake that bread is flour and all those things. The problem is it will be important for you to value the bread. If you add bread to flour to all those things, you are just simply double counting. So either you decide to add the value of all intermediate goods separately or take the final price of the bread. Okay. All right. Or you take the final price of the bread. All right. So intermediate goods are goods that you need to be able to produce a final good. All right. The problem with if you add intermediate goods, then you're more or less double counting some things. I hope I've answered you, Kamam. And then income. So the producers. So Isabella, it's not necessarily the producers. What we are interested in is with the income approach, we are interested in how much is paid to the owners of the factors of production. So if land is used, a certain rent is paid. Okay. If labor is used, a certain wage is paid. Those are the things we are interested in. Okay. Okay, so those are the things we are interested in. Okay. All right. I got distracted a little bit. That's what happens when you're teaching on Zoom. All right. Okay, so let's move on. So I hope I've been able to explain these things for you. Yes, Margaret. Margaret, is your hand up? You can unmute and ask your question.
Sir, please, my question is, does it mean intermediate goods can be raw materials?
They include raw materials.
Okay, all right.
Yeah. Yes. So far as you are not considering them as final goods. Okay. So they include raw materials so far as you are not considering those raw materials as final goods. Okay, so some of these raw materials can be considered as final goods for some particular firms. So for instance, I can do cocoa the cocoa beans. I can get the cocoa. There's a word they call it. When they can mill the cocoa, and there's something that comes out. That something is a final good for one particular firm, but it is an input that is being used by a chocolate firm to produce the chocolate. Okay, so when you are accounting for some of these things, you have to be very careful as to whether you are considering it as a final good or an intermediate good. So an intermediate good, you need that intermediate good to be able to get a final good out of it. Okay. All right. All right. Okay. So now let's move on. All right. So there are 3 approaches to calculating GDP. There's a product approach or the value-added approach. Measures economic activity by adding up the market value of all newly produced goods and services, excluding intermediate inputs, to avoid the problem of double counting. I mentioned this earlier on, to avoid the problem of quoto. It also computes economic activity. So that's an alternative approach. Compute economic activities by summing up all value added at each stage of the production. Okay, so you can decide to add up the value added at each stage of production, or just pick on what the market value of newly produced goods. The 2 approaches should give you the same value for GDP if you use the product or the value added approach. Okay. And then I think I've forgotten exactly the person who has this question. He was asking about the income approach. So here, when we follow the income approach, GDP is measured by summing up all incomes received by the factors of production. So I said workers receive a wage or a salary, fixed assets such as land and all those things, they receive what is called rent. Business owners receive what is called profit, and then capital and interest, and capital, the return for capital is what? Is interest. Okay. Margaret, is your hand still up or is the old hand? Margaret?
All right. So it's the old hand.
All right, that's fine. That's fine. Okay. All right. I hope you understand it now. Okay. So the product approach, there's this approach that you use, the income approach. All right. The returns to the factors of production. We are summing all of them up. Okay. And then there's the third approach, which is the expenditure approach. Here, GDP is measured by adding all spendings by the ultimate users of final output. All spendings by the ultimate users of what? Of final output. So household expenditure, firms' investment expenditure, government purchases of, we add all of this up. Okay. So know the distinction between the 3 approaches. There's the product approach, there's the income approach, and then there's what? The expenditure approach. Try and take your time and understand these different approaches. But the good thing is that irrespective of which approach you use, the value of GDP should be the same. So whether you use the income approach, total income should be equal to whatever you get from the product approach or output approach, and should be the same as whatever you get from what? The expenditure approach. That is what is called the fundamental identity. Okay, irrespective of which approach you use, irrespective of which approach you use, the value for GDP should be the same. Okay, it should be the same, irrespective of the approach you use. Okay. And an easier way of understanding it is using the circular flow of income. Okay, how businesses and firms operate. All right, so income is equal to expenditure. Why? Because what sellers of the total output receives must be equal to what the buyers do what? Spend. The product and expenditure approach must be the same because the market value of total production equals to the total amount spent on what? On it. And income should also be equal to production because the market value of production should equal to what is paid to the factors of production. Okay, so that's why I'm saying that when you use the circular flow that we discussed earlier on, it makes it easy for you to appreciate that whatever approach you use, of the three, any of the approaches that he used should end up with the same value for what? The same value for GDP, okay? It should end up with the same value for GDP, okay? All right. This identity means that all the three approaches to measuring GDP are equivalent, okay? I've said this over and over and over again, okay? All right, so I think this slide takes on each of the approaches. This is referring to the expenditure approach, okay? So the expenditure approach is the most common approach that is used in computing GDP. That is very, very common. So all you're interested in. So here, the Y is the value for GDP. Okay, so we are summing up expenditure from households, which we are going to call consumption expenditure. Then we add it to the expenditure by firms, investments. Then we add it to the expenditure by government. Okay, then we add a factor called net exports. Okay, so C is consumption expenditure. We are looking at expenditure on durables, non-durables, and services. Then I is gross domestic private investments. Oh yeah, and it's a combination of what? Business fixed investments, residential investments, and inventories. Goods that have been produced but not sold. Okay, goods that have been produced but not sold. Okay. Then government expenditure entails expenditure on law enforcement, defense, salaries of government workers, etc. And then capital expenditure on roads, other infrastructure is also all part of government expenditure. And then transfer payments, including SNP pensions, interest payments on debts, all is added up to G. Okay, so we have C, consumption expenditure, private investment, government expenditure. Now let's go to NX. NX is net exports. So net exports is simply the difference between what? Total exports and what? Total imports. Total exports minus total imports. Okay, so for the expenditure approach, these four items are added for you to come up with the value for what? For GDP. Okay, for you to come up with the value for GDP. So GDP is C plus I plus G plus NX. C plus I plus G plus NX. Okay, I think somebody's hand is up. Paul, you can unmute and ask your question. Yes, Paul.
You see, when you were mentioning the component of the consumption, the business, the investment, mentioned something like inventory, but you told us that the GDP measures for only a specific period. But from what I know, the inventory is for goods produced but not sold. So how come it's there?
So the inventory is goods sold. That is, so it is good that is produced. So again, we are referring to a particular good that has been produced within that particular year.
But not sold yet.
Exactly. So it is, that time period is still valid.
Okay.
If it is an inventory for a past period, you don't add it to the inventory that is required to calculate the GDP for that particular year.
Okay.
Right. Okay.
Thank you.
Right. Okay. All right. So GDP is C plus I plus G. It's important to know this particular. Let me go to the comment section. I think there's one more. Oh, okay. All right. So somebody was asking. So you can somebody confirm? Derek, you are being funny with that. So can somebody confirm is these slides? I'm told these slides are on Sakai. Unfortunately, I don't have access to the Sakai yet. So I don't know if these slides are on Sakai, but can somebody confirm that it's there? Or if it is not there, okay, so Comfort has just confirmed that it is there. So please try and go to Sakai and download these slides and go through them, okay? And go through them. I know today is the first class, but because we lost, I didn't want to go too much, but because we lost the first period, which we will make up for, by the way, I didn't want to go too much, but it looks like, let me just push a little bit and see where we can get to. Okay, I'll look for some time somewhere for us to see if we can make up for the time. Okay, Hannah has a question. Hannah, can you unmute yourself and ask the question?
Sir, please, do we have a situation whereby the net export is negative? That's the total import is more than the export.
Yes, it's possible. Yes, it's very, very possible.
Okay.
Yeah. It's just mathematics. I mean, if imports are more than exports, then the net export should be negative. It should be negative. All right. Okay, so let's move on a little bit. Let's move on a little bit and then see where we can end. We'll just go a little bit up. We are supposed to close at 3:20, right? I'll just give you some few minutes after 3 to be able to. So for those who would like to move to another class and that kind of thing. Lowell.
Yes, sir.
Yeah.
So please, can you go over the expenditure approach again? The formula, please.
Okay. All right. Okay, so the formula is what you see on your screen. Okay. So we are looking at so we are adding 4 things: consumption expenditure, gross domestic private investments, government expenditure, and then what? Net exports. These 3 things, when we add it, then we'll get the GDP using the expenditure approach. C is consumption expenditure, private domestic investments, government expenditure, and then net exports. What these slides are trying to tell you is what constitutes consumption expenditure, what constitutes investment, what constitutes government expenditure, and then what constitutes net exports. So I was saying that consumption expenditure, it is when you add durables, non-durables, and services that you get consumption expenditure. Then for the gross domestic private investments, we are adding business fixed investments, residential investments, and inventories for a particular time period. Okay. Then when we go to government expenditure, we are looking at expenditure on law enforcement, defense, salaries of government workers. Then capital expenditure on roads, other infrastructure. But it excludes transfer payments such as SNIT, pensions, interest payments on debt. I think earlier on I missed this. It should exclude, it shouldn't include, it should exclude transfer payments such as SNIT pensions, interest payments on debts, and that kind of thing. And then there is net exports, which is total exports minus total imports. Okay, total exports minus total imports. All right. Okay. I think I didn't select a class rep, but we had one for last semester. So can we maintain the same class rep? Can we maintain who was the class rep for last semester? I've forgotten the names. Who was the class rep for last semester? Group 4. Who was the class rep for last semester? Or do you guys want a new class rep? I just want somebody that I can be communicating with. Georgina. All right, yeah. So we'll maintain Georgina. And then there was a guy, I think so. Was there a guy? Yeah, so Georgina, if you have my number, just give me a call after the class. Okay, just give me a call after the class so that, it can make it easier for us to communicate. Okay. All right. Okay. So let's move on a little bit and then just end it there. Okay. So now let's look at okay. So there is this distinction between gross domestic product and gross national product. Okay, gross national product. Our interest is in measuring GDP by nationals of the country. So if it is GDP, if we want to know the GDP value for Ghanaians, then we call it what? GNP. So GNP is the market value of final goods and services normally produced by domestic factors of production during the current period. Okay, domestic factors of production. We want to look at the contributions of the factors of productions that are owned by only Ghanaians. Okay, same can be done for only Togo, same can be done for. So what is happening here is that the total final output, what we do is we do a little bit of an adjustment. And the adjustment we do is to add the total final output produced by, so what we do is the output produced by nationals that are in other countries. And then, so we are using two things, the output produced by nationals out of the country and then the output produced by foreigners in the country. So what we basically do is we subtract the output of foreigners in the country from the output of citizens that are producing in other countries. That term is called the net factor payments from abroad. Okay, the net factor payments from abroad. So NFP is incomes and, just a minute. Okay, so NFP is the incomes earnings paid to domestic factors of production by the rest of the world, less income paid to foreign-owned factors of production by the domestic economy. Okay, so that was what I was explaining. The net factor payments from abroad is incomes or earnings paid to domestic factors of production by the rest of the world, less income paid to foreign-owned factors of production in the domestic economy. Okay, so the contributions of, say, Ghanaians abroad, okay, less the contributions of foreigners in the domestic country. Okay, so that's what we are called the net factor payments from abroad. So we do this. So whenever that adjustment is done on the GDP, then the value you get is what is GNP. Okay, it's GNP. It's GNP. Okay, it's not very difficult to understand. So GDP. So when you add that particular adjustment to the GDP, then you get GNP. So GDP is just GNP minus NFP. So more or less, if we add this net factor payment from abroad to the GDP, what we will get is what is GNP. Okay, what you get is GNP. What you get is GNP. All right. Okay. I think we should end here because we are going to see some. I would like to end here. Allow you some time to go through the slides, at least up to the point where we ended, and then when we meet next week, we are meeting next week Tuesday. Okay, when we meet next week Tuesday, I'll just try and wrap up, and then we can move on. Yeah. So let me allow you some few minutes to ask any question that you have. Okay. Just some few minutes for you to ask any question that. Okay. All right. So let me see. All right. So I've seen the question from Isabella. Which approach is Ghana using? So I'll answer that question next week. Okay. I'll answer that particular question